Yeah, let's see a full-fledged question now on how we can prepare a consolidated balance sheet. They are saying that from the following summarized balance sheets of H Limited and subsidiary S Limited, drawn up to 31st March 2017, prepare a consolidated balance sheet as at that date. So we are supposed to prepare the consolidated balance sheet on 31st March 2017. Yeah, the information which they have given, they are saying reserves and profit and loss account of S Limited stood at 25,000 and 15,000 respectively on the date of acquisition of its 80% shares by H Limited on 1st April 2016. So they have given us a case of H Limited. H Limited has acquired 80% shares of S Limited, and these shares are acquired on 1st April 2016. So consider 1st April 2016 as the acquisition date. Acquisition date is important because from that date we will start applying accounting standard 21. Compare the acquisition date immediately with the balance sheet date. They have given us balance sheets on 31st March 2017. It means we have purchased the shares at the beginning of the current year. Right? One important thing. Whatever are the reserves of the subsidiary up to 1st April 2016, that will be pre-acquisition. And whatever are the changes in the reserves after 1st April 2016, that shall be post-acquisition. Right? So that's the reason there is importance of this information. One, reserves and P&L of S Limited stood at 25 and 15. This is on 1st April 2016. So this will turn out to be pre-acquisition in nature. Okay. But if you see the balance sheet, in the balance sheet, they are showing reserve now at 75,000. Reserve of the subsidiary is 75 now, and as you can see, when we acquired the shares, it is 25. So whatever is the change in the reserve that has occurred after 1st April 2016, that will become post-acquisition in nature. And similarly, if I look at the P&L, it's given a little bit later. If I see the P&L is given as 25,000. So just compare with information 1. If you see with information 1, P&L right now is 15, but in the balance sheet it is 25. This increase in the P&L is also after 1st April 2016. This will help you in carrying out a proper pre-acquisition, post-acquisition analysis of the subsidiary, which is one of the principles of consolidation. Okay. Second information. They are saying machinery book value 1 lakh and furniture book value 20,000 of S Limited were revalued at 1 lakh 50 and 15,000 respectively on 1st April 2016. The day when we are acquiring shares, on that very day, we are carrying out the revaluation. And then they are saying that for the purpose of fixing the price of the shares, right? Rates of depreciation computed on the basis of useful lives is 10% for machinery and 15% for the furniture. So what they have done is they have given us the point of revaluation. The effect of revaluation is still pending. If you read information too carefully, nowhere they are saying that the effect of revaluation is still left, but it is very obvious. From the figures, it is becoming very obvious. Just see. Machinery, they are saying book value is 1 lakh, and later on they are saying rate of depreciation is 10%. So if I do 1 lakh and deduct 10% from it, I will get 90,000. If you see the balance sheet of S Limited, machinery is shown as 90,000. That means 1 lakh is the book value on 1st April 2016. On that, we are charging depreciation at 10%. We are getting the book value on 31st March 2017. This clearly means that the effect of revaluation is still pending. Similarly, if you see for furniture, the book value is 20,000. And for furniture, the rate of depreciation is 15%. So if you take 20,000 and deduct 15% from it, so that will be depreciation of 3,000, I will get furniture as 17,000. So that is the book value. So the figures which are given in brackets are book value on 1st April 2016. If you had already given the effect of revaluation, then you would not have charged the depreciation on book values. You would have charged depreciation on the revalued amounts. But you have not charged depreciation on revalued amounts, which clearly means means that the effect of revaluation is pending. So when we carry out the consolidation, at that time, we shall provide the effect of the revaluation. And finally, they have given us the balance sheets. Yes, let's do a plain reading of the balance sheet. They have given us the share capital, they have given us the reserves, the P&L, the trade payables. Okay, on the asset side, we are having machinery, furniture, other non-current assets, shares in S Limited. We have purchased 800 shares. Our cost of investment is 1,60,000. Based on all this, we are supposed to prepare the consolidated balance sheet. Now, when we are preparing the consolidated balance sheet, at that time, right, at that time, we will have to give the effect of the principles of consolidation. I hope you have already watched my episode on principles of consolidation. If you haven't, then it is there on my YouTube channel. You can just watch that particular episode. Now, what are the principles of consolidation? The very first principle is line by line addition. Line by line addition. Right? This balance sheet which they have given to us, the assets, the liabilities, we have to simply do line by line addition of the amounts which they have given. Now, this I will do when I will prepare the final balance sheet. So, line by line addition of the assets and liabilities will not turn out to be a working note. So, we will give effect of it later. The second principle is to carry out pre and post acquisition analysis of the subsidiary. Now, if you want to do pre and post acquisition analysis, then you will have to run through certain working notes. See, I am acquiring shares on 1st April 2016. So anything that is existing on 1st April 2016 will become pre-acquisition. Anything that is happening after 1st April 2016 will become post-acquisition. So I'll have to run through certain working notes. The first working note will be to find out what is the increase in the reserves and surplus after 1st April 2016, because this will help us to track what is the post-acquisition. Then the second working note will be respect to the revaluation. See, we are doing revaluation on 1st April 2016. So that will turn out to be pre-acquisition. And then we will also miss out on depreciation, because since you have not given the effect of revaluation, you have calculated depreciation on, right? You have calculated depreciation on book values. If you give effect of revaluation, then depreciation should be charged on the revalued amounts. So that also we have missed out. And then we will do the main working for the pre and post acquisition, which will turn out to be the second principle of consolidation. Then the third principle, the cost of control, goodwill capital reserve. Then the fourth principle, minority interest. And then the fifth principle, the consolidated reserves and surplus. That's how we will be applying all the 5 principles. But yes, the first principle, line by line addition, does not become part of any working note. First principle will be actually applied last. Okay, it doesn't become a part of working notes. When we will prepare the final balance sheet, at that time we will do the line by line addition. So let's go one after the other. Let's start with the solution. I would like you to begin solution in this way only. We should first make it clear that H Limited has acquired 80% shares of S Limited, and we should jot down the acquisition date. The acquisition date itself reveals a lot many things. Up to 1st April 2016 pre-acquisition, after 1st April 2016 post-acquisition. Keep this thing in mind. Let's start with the working notes. The first one. Yes. Increase in reserves and surplus of S Limited during 2016-17. We have reserves over here. We have profit and loss account over here. We start with the closing balance. We say balance on 31st March 17, 75,000 and 25,000 less balance on 1st April 16. When we acquired the shares, reserve is 25,000 and the P&L is 15,000. That means after we acquired the shares, reserves of the subsidiary has increased by 50,000 and the P&L of the subsidiary has increased by 10,000. Next, I will like to do the working. See, if you are writing, then you can keep on pausing the video and keep on completing the solution. Yes. I will now like to give the effect of the revaluation. Is it 2? Revaluation effect. Right, we are doing revaluation effect for machinery and for furniture. See, we say book value on 1st April 16. I have the question with me. I am copying from it. Use information 2 in brackets. They will given you 1,20,000. And then we say revalued at on 1st April 16. Remember, the book value and the revalued amounts both should be on the same dates. They are saying that we are considering this as 1,50,000. They are considering this as 15,000. Right? So this gives us the revaluation effect. So we say revaluation effect on 1st April 16. Revaluation effect on 1st April 16. This is 50,000. This is minus 5,000. So the value of the machinery has increased by 50,000. The value of the furniture has reduced by 5,000. But always remember one thing. If you have missed out the revaluation, then you have also missed out the depreciation. You must have continued to provide depreciation on the book values, but you should have rather provided depreciation on the revalued amounts. So the adjustment is still not completed. We say now next, depreciation effect for, you are doing revaluation on 1st April 16. So depreciation is for 1st April 16 to 31st March 17, right? So we will provide depreciation not on a date. We provide depreciation for a period. So we say depreciation effect. Yes. Depreciation on depreciation on revalued amount, right? We should provide depreciation on the revalued amount. The revalued amount is 1,50,000 and the rate of depreciation is 10%, right? 1,50,000 into 10%. So we should provide 15,000 rupees of depreciation. Here it is 15,000 into 15%. So 15,000 into 15%, we should provide depreciation of 2,250. This we should compare with the depreciation already provided. We say less depreciation already provided. We must have provided depreciation on the book value. Book value is 10,000 here. So you must have provided 10,000 rupees. Here the book value was 20,000. So you must have provided depreciation of 3,000. So we need to work out the difference now. We say depreciation. We'll have two figures here to be provided. Another will be to be reversed. Okay. If there is upward revaluation, I have to provide depreciation of 5,000. While here, 750 rupees of depreciation needs to be reversed. This is the entire adjustment for revaluation. Yes, now one of the main principles. That will be our third working note. Pre and post-acquisition analysis of S Limited. Pre and post-acquisition analysis of S Limited. You'll say here on 1st April 2016. Here I'll say after 1st April 2016. See, after 1st April 2016, two items are changing. Reserves are changing and profit and loss account is changing. So I'm preparing two columns. It's going to be interesting. We are applying one of the main principles now. Yes, let's start with it. The day when you are buying shares on 1st April 2016, right? What are the net assets on that day? That is what we have to put under 1st April 2016. Net assets. Yes, you heard me right. Net assets means assets minus liabilities. But assets minus liabilities is exactly equal to share capital plus reserves and surplus. So remember that. We will start here with the share capital. Or you can be elaborate, you can say equity share capital. So you are buying shares on 1st April 2016. I'll just see the balance sheet. 1st April 2016. If you see the balance sheet of S Limited, its share capital is 1 lakh, right? Balance sheet is on 31st March 2017, but they have not given us any movement of share capital. So the day when we are buying the shares, the share capital is 1 lakh. Then I say reserves. You are buying shares on 1st April 2016. Use information 1. What is the reserves on that particular day? Right? The reserves on that day is 25,000. I'll cross verify with the workings also that we have done. See, this is the working that we have done over here. You see, the reserve on 1st April 2016, it is 25,000. And this is the increase, right? This is the increase in 2016-17. Increase in 2016-17 must have happened after 1st April 2016. So here we will say 50,000. Next I say profit and loss account, right? Profit and loss account. The day when we are acquiring shares, the P&L balance is 15,000 and then it is increased by 10,000. Again, this earlier working that we have done, we are using that only. 1st April 2016, this 15,000 is the balance on 1st April 16. This is the balance on 31st March 17. So obviously the difference of 10,000 is after 1st April 16. After 1st April 16 is post-acquisition. I have put it over here in the post-acquisition figure. Comfortable? Now, effect of revaluation. See, we will say revaluation on 1st April 2016. Tell me, when have you done the revaluation? 1st April 2016. Don't forget that, right? You have done revaluation of machinery. You have done revaluation of furniture. Machinery you have increased by 50,000. Furniture you have reduced by 5,000. You have to give the effect under the column of 1st April 2016. That is important. I'll take you to the working. See, I'll take you to the working. This is the working of the revaluation. Just see. Try to understand this, all these things logically. Okay, understand this logically. We are saying increase of 50,000. We are saying decrease of 5,000. But when you did revaluation on 1st April 16, if you are doing revaluation on 1st April 16, remember anything that is happening on the acquisition date will become pre-acquisition. So since you have done revaluation on 1st April 2016, I am putting it under the column of 1st April 2016. Right, that's the reason I'm putting it under the column of 1st April 2016. Now, very important and very interesting, very logical actually. If you follow my working notes, you will find everything logical, everything logical. We have to give the effect of depreciation now. See, depreciation for 1st April 2016 to 31st March 17. Right now, I have to give the effect of the depreciation. Okay, depreciation. I have to give effect of depreciation on machinery. I have to give the effect of depreciation also on the furniture. Just see the way I'm going to give the effect now. Depreciation, I have to provide additional depreciation of 5,000. Additional depreciation will be debited to the P&L, so your profit will reduce. And on furniture, depreciation is to be reversed, so it will be credited to the P&L. So here I keep it positive 750. If you see the column title is P&L. Okay, I'm putting it under the column of the P&L. You can always argue that revaluation you are doing, a revaluation effect you are giving in 1st April 2016, but the depreciation you are giving in the post-acquisition. Why is it so simple? Revaluation is done on 1st April 2016. 1st April 2016 is acquisition date, so I will give it as pre-acquisition. But depreciation is not on a date. Depreciation is for a period. Your depreciation is for 1st April 2016 to 31st March 17. 1st April 16 to 31st March 17. Isn't that post-acquisition period? Isn't that the post-acquisition period? And because it is post-acquisition period, its effect should be given in the post-acquisition column. Again, I will take you to the depreciation. Just see, this is our working note for the depreciation. Understand it logically, okay? Understand it logically. Understand this. For which period you have given the effect of the depreciation? You have given effect for depreciation from 1st April 2016 to 31st March 17. This is period after you acquired the shares. And if it is for the period after you acquired the shares, then it is post acquisition, isn't it? That is the reason. That is the reason I am giving effect under this column. It will affect my P&L. It will not affect my reserves. I will not debit or credit the depreciation to reserves. I will do it in my P&L, and that is the reason I have given the effect under the column of the P&L. Comfortable? Okay. So it is time now to take the totals. Time to take the totals. This is clear by observation itself. Yeah, if you want the full view of it, here it is. Right, I hope the column titles were already given. So second principle, pre and post acquisition analysis of the subsidiary has been done. Now we will apply the third principle. We have to work out the cost of control. The investment that we have made in the subsidiary needs to be cancelled. Right now, the parent and subsidiary are two separate companies, but when I will do consolidation, parent and subsidiary will be considered to be a single company. If you are a single company, then you cannot have shares with yourself, within yourself. So it needs to be cancelled. Yes. So that's our fourth working note. Working note number 4. Cost of control. I say cost of shares in S Limited on 1st April 2016. So we refer the question. We have purchased the shares for 1,60,000. It's a bit like accounting standard 14 in a way. This cost of shares will be understood as purchase consideration. Purchase consideration should be compared with net assets. So I say less share in net assets on 1st April 2016. Right, the date should match. You purchase the shares on 1st April 2016. My share in the net assets should also be on 1st April 2016. Now we have already done the pre and post acquisition analysis. Here it is, the column, right? Column 1st April 2016 is there here, 1st April 2016. What are the net assets on that date? 1,85,000. Go ahead. 1,85,000 into 80%. Do not compare 1,60,000 directly with 185. 1,60,000 is cost of 80% shares. So net assets should also be 80%. 148. You have paid 12,000 extra. 12,000 extra. That's your goodwill. Right. So we get our goodwill. 12,000. Time to apply principle number 4. That's our next working. Principle number 4. minority interest. You have acquired only 80% shares. Remaining 20% belongs to the minority shareholders. So we say 20% share in total net assets. Total net assets. Okay, total net assets. It's there in the earlier working itself. 1,85,000, then 50,000, then 5750. Whatever it is, multiply by 20%. Minority shareholders do not care whether it is pre-acquisition or post-acquisition, right? They are interested in how much they will get if the subsidiary goes into liquidation. So by chance on 31st March 17, the subsidiary goes into liquidation, 48,150 is payable to the minority shareholders. Fine. And now the final principle is to be applied. The final principle, you have to work out the consolidated reserves and surplus. Yes. So consolidated reserves and surplus. I prepare a column for reserves. I prepare a column for profit and loss account. This time we will say balance of. Now finally we have to take the balance of the parent. Balance of H Limited on 31st March 17. Check with the balance sheet. Pick up the balances of the parent. Two lakhs and 1 lakh. To this we will say add share from subsidiary. Parent has a right to participate in the reserves and the P&L which the subsidiary has earned after 1st April 2016. Right, the subsidiary has earned 50,000 after we acquired the shares. The subsidiary has earned 5750 after we acquired the shares. We have a right to participate in it. So 50,000 into 80%, 5750 into 80%. Okay. This is 40,000. So 2,40,000. This is 4,600. 1,04,600. In a way, out of those 5 principles of consolidation, principle number 2, pre and post acquisition analysis, completed. Principle number 3, cost of control, that is the cancellation of the investment, that has been implemented. Principle number 4, minority interest, implemented. And principle number 5, consolidated reserves and surplus, implemented. The first principle is pending, line by line addition. Now it is time to prepare the consolidated balance sheet. So we will now give effect for the same. Let's prepare the consolidated balance sheet now. Yes. Say consolidated balance sheet. Consolidated balance sheet of H Limited as on 31st March 2017. We prepare the broadheads. Right, so I've prepared the broadheads over here. The balance sheet is of the parent, so put the share capital of parent. So I put here 6 lakhs. Ideally, you should be preparing a note for reserves and surplus, but I'm just showing it below that itself. We will show here reserves. We will show here profit and loss account. Prepare a separate note. That's what you should be doing ideally. But say in exams, you may or may not have that much of time. So I'm just showing it over here. Okay, I'm showing it over here. Otherwise, if you have time, then prepare a separate note and show it. Reserves and P&L. Okay, what to do over here? You have to now look at the last working mode. We have already calculated it. Reserves 2,40,000 and 1,04,600. Let me store it in my calculator. Yes, this is what I will be showing in my balance sheet from our workings. Reserves 2,40,000. P&L 1,04,600. So reserves taken care of, P&L taken care of. There's a new head to be prepared now when you are preparing the consolidated balance sheet. The new head is to minority interest. I will report my minority interest from the workings. Minority interest, where is it? Here it is, minority interest, 48,150. Okay, 48,150. So 48,150. The third head, non-current liabilities. I see the balance sheet. I have trade payables, which is a current liability. So no non-current liabilities. Fourth and final head, current liabilities. Current liabilities. I'll show here trade payables. Now it is time to implement the first principle, line by line addition. There is no adjustment for trade payables. So just do a line by line addition over here. What do you say? 1,50,000 plus 57,000. Line by line addition, 2,07,000. I'm doing line by line addition, just adding the two figures and putting it over here, 2,07,000. So 2,07,000, 48,150, 1,04,600, 2,40,000, and 6 lakhs. 11,99,750. That's the total. You're writing, you can just pause the video here and complete your equity and liabilities. Below that, we will continue with the assets, right? Below that, we will continue with the assets. Continue in the statement, assets. But for our simplicity, I'm doing it over here so that I have the balance sheet and I can explain you in a better way. The first head over here is non-current assets. Non-current assets. Under that, I'll say A, property, plant, and equipment. You should prepare a note for it, but we will show it over here. The first one, machinery. See, machinery, we have to do line by line addition now. 3 lakhs and 90,000. See, I'm showing in brackets. 3 lakhs plus 90,000. But there is an adjustment with machinery. Be careful. We have done an upward revaluation of machinery. So add that. 50,000 was the upward revaluation. And because of upward revaluation, we have to charge additional depreciation of 5,000. So minus 5,000. Let's leave it over here for the moment. Furniture, that is the other one. Furniture. Okay. 1 lakh 50 and 17. First line by line addition. 1 lakh 50,000 plus 17,000. For furniture also there is a revaluation. We have done a downward revaluation of 5,000. So deduct that 5,000. And 750 rupees of excess depreciation was reversed. So add that back. 750. Add that back. Okay. So 3 lakhs and 90,000 and 50,000 and minus 5,000. 4 lakh 35. 1 lakh 50 and 17 minus 5 and add 750. 162 750. We then say B, intangible assets. Under that we say goodwill. Look at your working note, goodwill, cost of control working. Cost of control working, here it is. Goodwill is 12,000. Report that in your balance sheet, 12,000. Yeah, then they are saying other non-current assets. Other non-current assets. Line by line addition, 4 lakh 40 and 1 lakh 50. 5 lakhs 90,000. 5 lakhs 90,000. Then they are saying non-current investment, shares in S Limited, 1 lakh 60. This 1 lakh 60 is the investment in the subsidiary. We have cancelled it. And then we have calculated the resultant goodwill of 12,000. So this 1 lakh 60 will be no longer be repeated. Will no longer be reported. That investment has got cancelled. And after that, nothing is there. That means there are no there are no current assets. So we say current assets, there aren't any. Take a total. This is the assets. We take a total for the same. $1199,750. The working notes that we did for the purpose of consolidation, I'll show you again. And I challenge you, you compare those working notes with the ones which are there in the material of CA Inter given to you. You will find these working notes far, far more easier to grasp because they are logical. They go step after the step. If you see the working notes which are there in the solution which has been provided, uh, if you can understand that, really nice, but you will definitely find it very challenging. You go through these working notes which I have given over here. Initially, see, this is a full-fledged question of consolidation. So just you do one question and you grasp everything of consolidation, that will never become possible. But you just see, it is so logical. It is going step by step. Logically, one step forward we are going. We know we acquired the shares on 1st April 2016. So everything after that will be post-acquisition. So that's my first working note, that what is the change in the reserves during the year. Revaluation effect is properly given over here for machinery and furniture. Revaluation is happening on 1st April 2016, so pre-acquisition. Depreciation is after 1st April 2016, so post-acquisition. So logical it is, right? And that is how I captured the main working, the pre and post-acquisition analysis. And we work out what the same is. Then we are canceling the investment. So logical, you buy shares on 1st April 2016. Ask yourself, what is your share in the net assets on 1st April 2016? And the net assets, you don't have to do any separate calculation. Your earlier working note provides you that figure directly. Okay. And then you see the minority interest, the working note for pre and post, just add up everything and multiply with 20%, or for that matter, whatever is the percentage of minority, you directly get the minority interest. And finally, the consolidated reserves and surplus. Here is the place where we finally take the profit of the parent, and to that we add the share that we get from the subsidiary. Go through these working notes once again, and I'm absolutely confident you will find it very logical, definitely better compared to what is there in your study material. This is what I personally feel. What do you yourself feel? If possible, do let me know in the comment section so that I can improve upon the same. I hope you find this consolidated balance sheet preparation that much more simpler. That is my motto, that you find it simple.